This is Jason Ball of Ball & Company. Threats of a U.S.-China trade war are dominating the news. It is estimated that a trade war will subtract 1.8% from our GDP growth, cause a rise in unemployment, and cost the average American family between $500 and $800. Further escalation in trade tensions would have dire consequences. But if everyone knows this, why hasn't the market plunged? The answer is that China has a lot more to lose from the trade war than the United States. U.S. exports to China comprise just 1% of U.S. GDP. In the $19 trillion U.S. economy, the 1% of activity with China is not consequential. China's exports to the U.S., however, account for 4.1% of its GDP, and China has much more at stake. After the trade talks failed on May 10th, the Standard & Poor's 500 remained about 2% off its all-time high. With a 25% tariff on an additional $325 billion of imports from China threatened, on top of the 25% tariff previously levied against $200 billion of Chinese imports, one can certainly expect more volatility for stocks as the trade battle heats up. No one can predict the market's next move, which is why it is so important to be diversified. Stocks are only one asset class in a long-term, strategically designed portfolio, and stock prices don't always reflect fundamental economic trends. Frankly, the S&P 500 has remained remarkably resilient in the face of rising trade tensions. But over the long run, economic fundamentals are the key determinant of corporate earnings, which drive stock prices. We must continue to gauge the true impact a trade war, especially a prolonged one, will have on our economy. If you have any questions or would like to schedule an appointment, give us a call or send us an email. And feel free to share this video.